Welcome to Pagoda Podcast, where we explore ideas, strategies, and insights to help businesses grow and scale. I'm Steve, your host for today's deep dive, and we have a really fascinating topic lined up.
And I'm Nigam, CEO of Black Pagoda.
It's great to be doing this deep dive today because this is something I see founders get wrong constantly.
Yeah, exactly.
Mm-hmm.
So to kick us off, I want you, the listeners, just imagine the scenario for a second. Let's say you've poured years of your life, your blood, sweat, and tears into building a business.
Right.
And it is booming. You're generating massive amounts of cash. The revenue graph is just pointing up and to the right. And you finally decide, you know what, it's time to sell this thing, cash out, and sail off into the sunset.
The ultimate dream.
The ultimate dream, right. But then you actually sit down at the table with prospective buyers.
Yeah.
They look at your soaring revenue, they look at the company, and they basically tell you it's practically worthless.
Yep.
I mean, how in the world does a multi-million-dollar business get valued at zero? Well, it happens every single day. I mean, literally all the time. And it happens because founders and investors are, they're just using completely different scorecards.
Different scorecards.
Exactly. The person building the business thinks value is measured kind of like a high score in a video game. Just get the revenue number as high as humanly possible.
Right, get the high score.
But the person buying the business, they're looking at profitability, they're looking at predictability and risk. They really don't care about your high score. They care about the underlying engine of the business.
And we are pulling this straight from a really insightful set of strategic materials provided by Black Pagoda. And they specialize in the actual mechanics of business valuation.
They do, yeah.
And the most common myth highlighted in the sources like the absolute biggest misconception in the business world is this firm belief that valuation is based almost entirely on revenue.
Right, because top-line revenue gets all the headlines.
Right.
When we read about a startup in the news, the media always talks about how much they made in sales. But investors look much, much deeper than just cash flowing in. They aren't looking to buy like mere activity. They are looking to buy a sustainable wealth-generating asset.
Okay, but let me push back on that right out the gate because I think a lot of people would argue with that.
Sure, go for it.
Isn't massive revenue the ultimate proof that people actually want what you're selling? Like, if I start a company and I hit $10 million in sales, I've captured market share.
You have, yeah.
It feels like a blockbuster movie to me. Like, if a movie makes $1 billion at the box office, it's a massive hit. Who cares what the underlying metrics are if the top line is $1 billion?
Well, okay, if that movie makes $1 billion at the box office, it absolutely proves people wanted to see it, obviously. But what if that exact same movie cost $2 billion to produce and market?
Oh, well, then the studio's broke.
Exactly. The studio is completely bankrupt. And that is exactly how an investor models a business. Revenue without profit and revenue without predictability is really just a giant liability.
Sure, I get that. But if I have $10 million in revenue, I still have an enormous customer base. Couldn't an investor or like a private equity firm just buy my company, fire half the redundant staff, fix my broken margins, and suddenly, boom, they have a cash cow?
I mean, private equity firms do that all the time.
Yeah.
But here is the critical catch for you as the founder. They will not pay you a premium for the privilege of doing all that hard work themselves.
Ah, I see.
Right. If you hand an investor a messy, totally inefficient business with great market share, they view it as a turnaround project.
And turnaround projects are cheap.
Super cheap. They will heavily discount the price. They might still buy you, but they're going to buy you for pennies on the dollar.
Which brings us to a concept we really need to define early on in this deep dive.
The valuation multiple.
Yes, the valuation multiple. Because businesses aren't generally sold for a flat sticker price based on last year's sales.
Right. They are sold as a multiple of their core earnings. Exactly. When a buyer looks at your business, they determine your core operational profit, and then they multiply it by a number. Maybe that multiple is 3, maybe it's 5, maybe it's 8.
And what determines that number?
That multiple is essentially a direct measure of their confidence in the future of your business. Every single flaw, every inefficiency, every risk in your company drags that multiple down.
So top-line revenue just kind of gets you in the room.
Basically, yeah.
But it doesn't dictate the multiple at all. So if top-line revenue is just the flashy movie poster, what is the actual metric that drives that multiple? Where are buyers actually focusing their magnifying glass?
They focus heavily on a specific operational metric, which we highlight a lot at Black Pagoda, called EBITDA.
Right. EBITDA. We hear this acronym constantly in the financial news. earnings before interest, taxes, depreciation, and amortization. It is a massive mouthful.
It really is.
I always like to think of it like looking at the actual nutritional label on a box of cereal.
Oh, I like that.
Right, because the front of the box has the giant letters saying like fortified with vitamins, and that's your top line revenue, the flashy marketing.
Yep.
But EBITDA is the investor physically turning the box around to read the raw ingredients. They strip away the marketing to see how much actual nutritional substance is in the box.
That's a great analogy. And specifically, they use EBITDA to strip away the financial noise that has nothing to do with the core daily operations of the business.
Like what kind of noise?
Well, a standard profit and loss statement is really cluttered.
Mm.
It includes your specific tax rate, which, might completely change when the buyer takes over. It includes interest payments on your business loans, which the buyer is probably going to wipe out anyway with their own capital.
Makes sense.
So EBITDA gives the buyer this crystal clear apples-to-apples picture of the true operating performance of the machine itself.
Wait, hold on though. I get stripping out taxes and interest, but what about depreciation?
What do you mean?
Well, if I own a logistics company, my delivery trucks are going to die eventually. They rust, they break down, the engines fail. I will eventually have to buy new ones. Isn't ignoring depreciation just pretending that real-world expenses don't exist?
That is a very, very common criticism of EBITDA. And you are entirely right that trucks wear out. But investors don't ignore that expense at all. They just categorize it differently.
Oh, so?
EBITDA separates the day-to-day operations from the capital structure. Buying a brand new fleet of trucks is a capital expenditure, or CapEx.
Okay.
Running the delivery routes efficiently every single day is an operational expense, or OpEx.
Mhm.
Investors want to look at the pure operational efficiency first.
So they look at the routes first.
Exactly. Once they know the daily routes are actually profitable, then they'll model out the capital expenditure separately to see if the overall long-term investment makes sense.
Okay, that makes perfect sense. They isolate the daily engine from the long-term equipment purchases. Let's put this into a concrete example for the listener to really show how this changes evaluation.
Sure, let's compare two hypothetical companies.
Perfect. Let's say Company A is a massive operation. They are doing $10 million in annual revenue, but they are super inefficient, their margins are razor thin, and they have this chaotic management structure.
Sounds stressful.
Very. And after we strip away all the noise, their EBITDA, their true operating profit, is only, let's say, $500,000.
Okay, so a $10 million behemoth throwing off only $500,000 in profit.
Exactly. Now look at Company B. They are much smaller. They're doing only $3 million in annual revenue, but they are lean, their systems are perfect, and their margins are incredibly high.
Right.
Their EBITDA is $900,000.
So Company B makes less than a third of the gross revenue, but nearly double the actual profit of Company A.
Exactly. So how does a buyer look at that?
Now watch what happens with the valuation multiple.
Yeah.
Investor looks at Company A, sees the chaos, the thin margins, and says, this is really risky. I'm only giving you a 3x multiple. 3 times the $500,000 EBITDA means Company A sells for $1.5 million.
Even though they do $10 million in sales, that's crazy.
Yep. Then the investor looks at Company B. High margins, clean systems, extreme efficiency. The investor feels very confident about the future, so they assign an 8x multiple.
Huge difference.
Massive. 8 times their $900,000 EBITDA means Company B sells for $7.2 million.
That is wild. The company with a fraction of the revenue sells for almost 5 times as much money simply because the underlying machine is fundamentally healthier.
And that is exactly why the source materials emphasize expanding your margins. If your margins are expanding as your revenue grows, it signals to a buyer that you don't have to hire a new employee for every single new customer you bring on.
Your systems take the load instead.
Exactly. That proves scalability, and scalability is what drives up that multiple.
But here's the catch with relying just on that spreadsheet math, right?
Yeah.
EBITDA really only tells us about the money you have made in the past. If I am writing a multi-million-dollar check to buy your business, I am buying its future. How do I know that this beautifully efficient EBITDA won't just vanish next month? I mean, the math doesn't matter if the actual humans paying you decide to leave.
Which is exactly why we have to examine the customer foundation. A business is only as reliable as the loyalty of its customers. Black Pagoda notes that a business with high revenue but constantly churning customers is significantly less valuable than a smaller business with extreme customer loyalty.
Right. Churn being the rate at which you lose customers. I imagine an investor looks at high churn like a leaky bucket.
Is the ultimate leaky bucket. Let's think about the mechanics of customer acquisition cost, or CAC.
Okay.
If it costs you $500 in marketing and sales effort to acquire a new customer, and that customer only spends $400 before they churn out and leave,
You're losing $100 every time.
right. Your revenue graph might look like it's going up because you're signing new people, but you are literally bleeding cash with every single transaction.
So from a buyer's perspective, they don't just want a customer, they want a predictable annuity.
Precisely. If you have a customer base that renews their software contracts every year or
Yeah.
buys your coffee beans consistently every single month without you having to aggressively market to them, you have stabilized your future.
That makes sense.
And this feeds directly into lifetime value, or LTV.
Meaning the total amount of money a customer will spend with you over the entire course of their relationship with your business.
Right. If you have low churn, your LTV skyrockets. If you can prove to an investor with hard data that every new customer will stick around for, say, an average of 5 years and spend $10,000, you've handed the investor a highly predictable mathematical formula for growth.
Because they know exactly what they'll get back.
Exactly. They can confidently inject capital into marketing because the return is mathematically guaranteed. That kind of predictability sends the valuation multiple through the roof.
Okay, so a founder is listening to this and they do everything right. They have great margins, their EBITDA is solid, they've stopped the leaky bucket, and they have incredibly loyal customers. It sounds like they're totally ready to cash out.
You would think so.
But the source material warns that even with all of this perfection, there are hidden structural threats that can instantly kill a buyer's confidence.
Yeah, we are entering the territory of systemic risk here. And the most dangerous valuation killer mentioned in the sources is owner dependency.
Meaning the business literally cannot function if the founder takes a vacation.
Exactly.
I always think of this like a championship sports team that relies entirely on a single generational superstar player to score every point and call every play.
Great way to look at it.
Right. If that one player twists an ankle or in the business world decides to sell the company and retire to a beach, the entire system collapses. The team goes from first place to last place literally overnight.
And how do you think an investor mathematically handles that threat? I mean, they don't just hope for the best.
Do they just walk away from the deal entirely?
Sometimes they do walk away. But if the underlying product is good enough, they use a mechanism called an earnout to protect themselves.
An earnout, how does that work?
They will say, okay, we agree the business is worth $5 million, but we are only giving you $2 million in cash today. The remaining $3 million is an earnout.
Meaning you have to earn the rest of your own money?
Yep. You have to stay on as an employee for the next 3 years, hit strict growth targets, and transition all your relationships to our team. If revenue drops when you aren't the boss anymore, you lose that $3 million.
Oh, wow. So the founder's dream of selling the company and sailing off into the sunset is totally destroyed.
Completely.
They just signed up to work for a new boss under immense pressure for 3 years, all because they didn't build systems that could survive without them.
Exactly. A buyer wants to purchase a self-sustaining machine, not a job. They want institutionalized knowledge, standard operating procedures, and, a middle management team that can actually run the day-to-day. If the founder is the only one who holds the key client relationships or the only one who knows the proprietary recipe, the risk is simply way too high.
The sources also pair owner dependency with another massive structural risk, which is client concentration, the so-called whale clients.
Oh yeah, having a whale client feels amazing when you're building the business. Landing a massive corporate account that doubles your revenue is totally a reason to celebrate.
Sure.
But when you go to sell, if 60% of your revenue comes from just 2 massive clients, the investor sees a ticking time bomb.
Because if one of those decision makers at the whale client retires, or they decide to switch to a competitor, your multi-million-dollar business is suddenly bankrupt.
Exactly. The investor will heavily discount the valuation multiple to account for that severe concentration risk. They much prefer a highly diversified customer base where losing any single client, even your absolute biggest one, is just a minor speed bump, not a fatal iceberg.
Wow. So we've navigated the illusion of revenue. We've optimized the engine of EBITDA and margins. We've secured the fuel by lowering churn and raising lifetime value.
Yep.
And we've mitigated the risks of owner and client dependency. You have essentially built the ultimate, highly valuable machine. But There is one final massive hurdle before the check actually clears. You have to
Yeah.
prove all of this to the buyer.
The packaging. And this is where the Black Pagoda insights really emphasize how many deals just completely fall apart at the finish line.
Really?
Oh, yeah. You can build a fundamentally great business, but if you have messy financials and a lack of clear reporting systems, you simply cannot cross the finish line.
Why does messy bookkeeping kill a deal if the underlying business is actually making money? Like if the cash is there, why does it
I-
matter?
Because the buyer is fundamentally taking on a massive amount of risk. The only way they can get comfortable with writing that check is by verifying the data.
Yeah.
If a buyer comes in to audit your books and sees that you're like mixing personal expenses with business expenses, or you use cash accounting instead of accrual accounting, so your revenue is booked months before the service is actually delivered.
Red flags everywhere.
Exactly. The buyer's brain immediately goes to the absolute worst case scenario.
Right. If they can't trust the spreadsheet, they assume the actual operations must be an absolute disaster behind the scenes.
Trust evaporates.
Mm-hmm.
And when trust evaporates, the multiple drops. Buyer either walks away or they slash their offer by 40% to pad against the unknown risks they assume are hiding in your messy data.
And this is exactly where advisory firms play such a critical role. The sources highlight that firms like Black Pagoda, they don't just come in and magically fix the numbers out of thin air. They provide a vital service, which is essentially translation.
Translation is the perfect word for it because as a founder, you speak the language of your specific product, your industry, and your daily grind. But an institutional investor speaks the language of risk, return, CapEx, EBITDA, and scalability. Advisory firms act as that translator.
So you reformat the reality of the business?
Exactly. We clean the historical data, organize it into standardized formats, and present it so the investor can easily plug it into their financial models and actually forecast the future.
There is a phrase from the material that really sums this up. It's about positioning, not just performance.
I love that phrase.
Right. Performance is the blood, sweat, and tears of what you have achieved. But positioning is how you frame that achievement in the context of the buyer's strategic goals.
Exactly. Like if a strategic buyer is acquiring your company specifically because they want access to your highly loyal customer base, you don't lead the pitch by bragging about your flashy new office space or your top-line revenue.
You tell them what they want to hear.
You position the data to aggressively highlight your microscopic churn rate and your massive customer lifetime value. You speak directly to what they're trying to buy.
You give them the exact metrics they need to justify paying a premium multiple. It all comes back to clean data building trust.
100%. And if I had to summarize the ultimate takeaways from everything we've talked about today regarding business valuation, I'd boil it down to three things.
Let's hear them.
First, you absolutely must know your numbers, specifically EBITDA and your profit margins, not just revenue.
The real engine.
Exactly. Second, you have to actively reduce risk. That means stepping back from the day-to-day to lower owner dependency and diversifying your client base so you aren't reliant on whales.
Right.
And third, you have to position the business for the buyer. Clean up your financials and present your data in a way that builds trust and proves future predictability. Because a buyer is never paying you for your past hard work. They are paying for future predictable cash flow with minimal risk.
That is so well said.
If you can build a system that delivers that and present it transparently, that is where life-changing wealth is actually created.
It requires a complete paradigm shift, doesn't it? You have to stop looking at your business as a high score you are trying to max out and start looking at it as an engine you are trying to perfect.
Exactly.
Well, as we wrap up today's deep dive, I want to leave you, the listener, with a final provocative thought. We have spent this whole time talking about corporate structures, private equity, and million-dollar buyouts, but I want you to apply these exact principles to yourself.
Oh, that's interesting.
Think about your own career trajectory, your personal brand, or a major initiative you manage at work. If an investor were looking at you right now, what is your personal owner dependency?
Wow.
Are you building repeatable systems, sharing knowledge, and creating scalable value for your team? Or are you just generating revenue, which in a career just looks like endless activity and busyness?
That's a great question.
Because if everything completely stops the second you take a day off, or get sick, or leave the company, you aren't building an asset. You're just a bottleneck. So take some time today to think about how you can improve your own personal metrics. Stop just grinding out activity and start building a self-sustaining machine.
Love that.
And if you are building a business and want to learn more about translating your hard work into real, scalable value, make sure you visit www.blackpagoda.com. Until next time, keep digging deeper.